Meeting of the Investment Subcommittee, which is being held at County Hall in Glenfield. This meeting will be broadcast live via the County Council's website and will also be available for viewing afterwards. Can everyone please remember to switch the microphone on when speaking, and more pertinently to turn it off when you finish speaking. I'm probably guilty of more than most of forgetting to do that. I have today received apologies from Mr. Bill, and we also have Councillor Adam Clark, who will be joining us later on online. So we'll await his arrival. First item on the agenda is the minutes of the meeting held on the 26th of July 2023. I propose the minutes of the meeting held on the 26th of July are taken as read, confirmed and signed. Is that agreed? Yeah. Yep. Great. The next item on the agenda, which is question time. I've received no questions, and agenda item 3, questions asked by members understanding orders 7.3 and 7.5. We have no questions. Agenda item 4, to advise of any other items which the chair has decided to take as urgent on the agenda. There are no urgent items. Item number 5, declarations of interest in respect of items on the agenda. Does any member have any interest that they wish to declare this afternoon? Yep, Roy.
I don't actually consider I've got a declarable peculiar interest. Members should be aware that I manage funds that are invested in legal and general various passive funds.
Yep, thank you, Roy. Thank you. We'll note that. The next item on the agenda is the LGPS Central Multi-Asset Credit and Investment Grade update. And we have with us Cara Forrest and Anne-Marie Patterson, will present later on. Bulesh is going to introduce the report. Bulesh, over to you, please, first.
Thank you, Chair. So the purpose of this report is to provide the subcommittee with information on the Leicestershire Pension Fund's MAC, that's multi-asset credit and investment grade credit investments held with LGPS Central, and the performance of the 2 mandates held with them. We do have a PowerPoint presentation which will be delivered after this paper by representatives in the room. Just a bit of background, the fund has a MAC and investment grade credit allocation with Central. One's held within the income asset group and the other within the protection asset group. The value of the 2 investments in total is about 360 million at the end of June, or about 6% of total fund assets. For additional context, Central are the fund's single largest manager. The fund, as at the 30th of June, has assets worth 2.3 billion, or about 40% of total fund assets managed by Central. In addition, the fund has also got about 0.9 billion of low-cost collectively procured passive equity investments invested with legal and general, which it classes as pooled. Taken together, those 2 are valued together at 3.2 billion, or about 56% of total fund assets. There is also, at the time of writing, an additional 400 million committed to Central investment products, which will be called over the coming years. The fund also has approval to commit a further 280 million to Central, in addition to the 400 already mentioned, to 2 vintages of the LGPS Central private credit vintage, which is ready to be set up later this year. All in, a fair amount already pooled, with a significant pipeline that will also be managed by Central. Point 6, there's probably one thing to point out on that table, which is the 2023 SAA target for multi-asset credit at 9%. Our current weighting is about 5% below that at 3.7%. Point 7, I believe, underscores the current position and how we intend to close that gap. Point 8, similar to previous meetings, covers 4 areas that the presentation will cover. I won't read them out, but points 8.8a to point 8d. If there's no further questions, I'd like to hand over to our guests.
Thank you, Bulesh. So, over to you, Cara.
Yeah, hi. Good morning, good afternoon, everybody. My name's Cara Forrest. I'm head of clients at LGPS Central. So we're here to talk to you today about your multi-asset credit and investment grade credit investments. You won't actually hear a lot from me. I work closely with Bulesh behind the scenes, really. But it is the Anne-Marie show today, who is our investment director of fixed income. So I'll hand over to her to take you through the presentation.
Thank you. You want your slides? Yeah. I think we've got copies of slides as well. Okay.
If you could just turn to slide 4, please. Good afternoon, everybody, and thank you for inviting us this afternoon. As already mentioned, my name is Amarina, head of the fixed income desk at LGPS Central. And I think I'd like to start with telling you a little bit about our Global Active Investment Grade Bond Multi-Manager Fund, a very sharp, snappy title, but it was the first fund that was launched on the fixed income desk. It has just had its 3rd year anniversary. It was launched on the 23rd of March 2020, which was quite memorable for most people in the fact that it was the day that the actual country went into formal lockdown. So quite a day to launch a fund. It is the fund's objective is to outperform a benchmark index by 0.8% per annum over a rolling 3-year period, and it is run against a bespoke 50-50 benchmark, that is 50% sterling and 50% global, and this is to align with the assets that are within the portfolio, because there is quite a high weighting to sterling within that. The fund structure is an ACS, which was we took a lot of advice when we launched the fund, and that was decided was the best structure for us to go forward with all our funds. And we have 2 managers managing the fund, and they both have a 50-50 split of the AUM. Mandate guidelines for these funds are that the fund predominantly invests in investment grade corporate bond funds, corporate bonds. It is not permitted to invest in emerging market debt or sub-investment grade corporate bonds. Having said that, there is a slight allowance within the fund to allow for investment grade bonds that are downgraded, for the managers to effectively exit these positions. If we said that they would have to immediately sell, then that would be detrimental to the portfolio. So we give them a little time for the value to actually right itself before they exit, just to efficiently manage the portfolio and make sure that we're not locking in losses where we don't need to. At least 90% of the fund is hedged to GBP, but in actual practice, it's 100%. The managers don't take any active currency risk within this fund. And no more than 10% can be invested in off-benchmark positions. The reason why we give the managers the flexibility to invest in off-benchmark positions is so that they can actually participate in new issues of bonds. These new issues come within the month, and they don't actually enter the index until the end of the month when the index is rebalanced. And so this just gives them the full scope to actually invest in the full universe that they can do. They are allowed to invest in up to 10% in UK or US government bonds. This gives them a little bit of, because they only have a 5% cash limit, this it gives them a little bit more of a safe haven to put money, especially when they are hedging the fund to actually manage the FX currencies that are actually done. There are no constraints on sector or geographic allocation. We leave that to the managers to decide where they feel that the portfolio is best appropriately positioned. And no single investment should be more than 5%, but that is just to make sure that we get a diverse portfolio within the fund. And finally, derivatives are only used for efficient portfolio management. It's not a big part of the strategy, but obviously having it hedged to sterling derivatives are actually required. Turn to the next slide. Please feel free to ask any questions as I go along as well. Slide 5 actually shows the performance for the fund, and I think it's fair to say that in the 3 years that the fund has been running, it has been a very challenging time for fixed income in general, and particularly last year, 2022, was particularly bad for the fixed income sector in general, and the investment grade portfolios suffered along with a lot of their peers in the market. And the strategy is actually very the inflation and interest rate rises and that cause extreme volatility in this strategy. And as you are aware, there has been quite a lot of that, and a lot of central. I have a question.
In terms of the fund performance, is that just capital, or is that capital and income? And if it's capital and income going forward, what's the sort of running yield of?
Yeah, that's a good question. It is capital and income, and going forward, it is looking yield-wise. It's looking a lot better. When the fund was actually launched, the yields were around 3.5% on a bond for this strategy. It is now double that because of the recent market environment that we're in. And to be honest, the fund hasn't actually performed that badly in this challenging environment. It is running just short of the benchmark at the moment. It has underperformed the target, but as we say, markets have been very challenging, and the managers were actually caught out a little. Well, not caught out, but their investment in the gilts and the treasuries affected the performance quite a bit last year as well, particularly in Q3 last year with their UK gilts holdings that they had at the time. As you can see from,
Beside each other is difficult, isn't it? And the performance against the benchmark is one thing. How has it performed against the peer sector? Have you done as well or badly as the people competing with you in the same market?
Because it's a bespoke portfolio that we run in a bespoke fund, because it has such a high weight into sterling, it is hard to find peers to actually match like for like in the market. But what we have done is measured the managers with their global products against the global products in the market, and we found that they have matched and performed in line with their peers, to be honest. Fidelity has slightly underperformed, but I will mention that in a minute. So in general, the fund has performed in line with what the other managers in the market are doing. It's just been a really challenging environment market-wise. Fidelity, as you can see from the bottom table, has quite obviously underperformed against Neuberger Berman. This we were aware of. We were expecting it. When we chose the two managers, they have two very different styles to actually run this money and manage the strategy. Neuberger Berman have a US focus and a very diversified portfolio, whereas Fidelity are far more concentrated and they have a Europe and UK focus. Because Europe and UK underperformed the US, we fully expected that Fidelity would underperform Neuberger Berman, and so there was really no surprises there. And also being concentrated, a more concentrated portfolio, it did lead to more volatility with that manager rather than the other one. But it is, as we expected, it is what we thought would happen. There's been no great surprises, and we have no major concerns with either of the managers. And in fact, this year, as the market is beginning to become more positive for the strategy, Fidelity, particularly this quarter and continuing into Q3, has started outperforming the other manager. Some of the underperformance in the portfolio is actually rebounding, and they have actually been the stronger manager for the last 6 months now. So
if I may come back, presumably knew a lot of that when you set the targets, but to fall short by 1.47% to me is quite a considerable.
Yes, it's disappointing that we haven't made the target. The only thing that I would say is that there have been some very specific things that have led to some of the underperformance, and the managers are confident and they've made us comfortable with some of the underperforming assets which are now held in the portfolio at what are we consider considerably undervalued, and we think that the market will rebound, and we do think that some of this performance will be recovered over the next 12 months as the markets right themselves, and as we can already see signs that inflation is slowing. We can also see signs that the interest rates hikes aren't quite as aggressive. So it does seem to be that these the things that were impeding the fund are actually beginning to turn, and the market environment will be a lot more favourable going forward.
The geopolitical situation challenges some of that logic because the gas supply in Europe's been damaged by apparently Russian activity, so inflation's expected to go back up again now. So it's a very difficult world.
It is, yes.
Okay, thanks. Carry on.
Are there any questions on the performance for the managers as well?
Anybody got any further questions? I mean, obviously it has underperformed, and really the key message seems to be that it will come right. I mean, I fully, I accept what Roy says about gas pipelines being blown up and wars in Israel. But nevertheless, we have to deal with the real world. And the world, as we said earlier, is not perfect. But you would expect the performance of this fund to be considerably improved over the next 12 months.
We would do, yes.
Yeah. Okay. Has anybody else got any other questions that they want to ask? No? Okay. So we are, if there are no further questions,
Sorry, we've just covered
all right, carry on.
performance of the
I'm trying to
multi-asset
cut it short, Cara.
Right, the second fund is our multi-asset credit fund. This is a newer fund. It was launched in April 21. It is also an ACS structure, and that is also managed by two managers with the AUM split 50-50. We have Columbia Threadneedle, and also we have Western Asset managing the fund. The fund objective of this one is to outperform 3-month GBP SONIA by 4% per annum net of fees over a rolling 3-year period. The mandate guidelines for this fund are that the managers can invest in a range of global and fixed and floating rate instruments. The idea is that they actually allocate to higher performing assets, whereas avoiding the more negative bonds within the fixed income sector. They have no restrictions on country or sector allocation. They can go where they want, apart from at the moment they've got up to 10% in emerging market debt. They can have up to 10% in investment grade bonds and up to 15% in government bonds. Also, with this fund, 90% of the fund needs to be hedged back to sterling to align with requirements of the partner funds, and there is a limit to 30% for any sector within the portfolio, just to keep the portfolio diverse and to make sure that the managers are investing in a range of fixed income sectors. And derivatives are also used in this fund just for efficient portfolio management, not as a major part of a strategy. I think that this fund is one of the ones that can be shown as a good example of how we don't just launch a fund and then leave it. We are, along with the collaboration of the partner funds themselves and their advisors and consultants, we actually look at these funds on a continual basis. And after 2022, we did actually look at this fund and the guidelines to see if it was actually too rigid, because it did actually underperform last year, and we had a look to see if we could be a little bit more flexible to maybe give the managers a little bit more scope to actually protect the funds when you have such a negative market that they were actually operating in at the time. And as a result of that, we have actually decided to give the managers some more flexibility in these guidelines, and we are now towards the later stages of that actually being approved by the FCA to actually be implemented within the fund. So we have increased the limit to investment grade corporate bond to 15%, and also increased the cash limit from 5% to 15%. These are safer assets which will give the managers more flexibility in negative markets to protect the portfolio. And also we've given an increase in the emerging market debt allocation from 10 to 15%. And that is also to give the managers more flexibility in a risk-on market to actually recover some of the underperformance that they've experienced over the last 12 to 18 months. Are there any questions?
Want to raise? Yeah, do we?
Thank you. Just, the last point you mentioned about increasing from 10 to 15% in emerging market debt. This might just be my misunderstanding or lack of knowledge between the difference between the MAC and the previous category you talked about, where it says nothing in the emerging markets. What's the difference?
Right. The first fund that we talked about is just an investment grade corporate bond fund.
Okay.
And the global corporate bond, we just decided that we keep it developed markets investment grade. The emerging market part of the index is very, very tiny. So we decided we wasn't going to go there. The MAC fund is a go anywhere product. Just because we've increased the limit to 15%, it doesn't mean that allocation will automatically go to 15%. It just means that if the market environment is right, we've given the manager the allowance to actually increase their allocation there to actually benefit from some of the rebounds from the extreme sell-off that this sector has had over the last 12 months.
If I can, I've just got
Yeah.
to follow up. In terms of the performance overall, the fixed income markets have taken quite a hit. I'm assuming the strategy is the long-term view.
It is.
If you try to exit the market in any of those fixed income now, you're probably going to take a loss. And that's not what we're actively looking to do. So I'm assuming that the strategy for now is holding them all to term in terms of the bonds.
Not so much so. It's we don't tend to hold bonds to term as such. It's more to do with the market environment, the market allocation, and the managers are continually looking at the bonds that they've got in the portfolio against what else is in the market, because they are active managers. They will actually trade and they will exit a bond if they feel that there is a better alternative in the market. And sometimes they'll exit the bond if they want to change their strategic allocation, and there's a bond that's particularly performed well, they will actually crystallise a profit there. So there is a continual trading of the bonds. They don't hold them. They will sometimes hold them to maturity, but in general they don't. It's a continuous evolvement of the portfolio. Do you go on to the next slide, please? The reason why that we show this slide is because, as I said, it's challenging markets for fixed income sectors, and this is the performance of the sectors in the life of the fund, the MAC funds, so since the 15th of April 21 until August 23. And as you can see, there are some very negative sectors within this, the fixed income sector in general. And the green column actually shows where our MAC fund sits with this. And as you can see, it has outperformed the majority of the fixed income sectors. There are some that have actually outperformed it, but US RMBS, it is quite a niche single strategy. So in general, the fund has done what it was designed to do. It's managed to mitigate some of the losses. Unfortunately, what it couldn't do was actually meet the objective of the fund, which is a cash plus objective, which is positive. And in these markets, as you can see, everything was negative. So unfortunately, it was challenging, if not impossible, for the managers to actually meet the target in the market environment that they were actually working in, particularly last year. And I think if we carry on, if we did the next slide, we'll talk a bit more about performance. As you can see, the fund has underperformed the benchmark and it's underperformed the target. As I've explained, it's a long only fund, it can't go short. It has a very limited use of derivatives, and so it would have found it extremely challenging to get anywhere near a target. It is also a very new fund, which means that the objective is a long-term view, and in funds that would have been going for longer, they would have had periods of outperformance that would have absorbed some of this underperformance. Unfortunately, this fund is quite new and that hasn't happened. So it's actually affecting the since inception figures on it. And out of the two managers, once again, we've got two very different styles. Western Asset have a much larger loan portfolio and they are more US based. DTI very much play, they have a focus on the crossover between high yield and investment grade. So they're looking at two completely different ways of managing the strategy. They've actually worked very well together. CTI are more conservative and they tend to mitigate some of the losses when markets are negative, whereas Western Asset are a little bit more aggressive and they will outperform in positive markets. The one thing that I could say going forward for this fund is that we are in a much better place with a much better outlook for this strategy moving forward. As I've already said, yields are a lot higher than they were. The markets that they're working in have been subject to huge sell-offs over the last few months, and some of that will be rebounded, and there will be opportunities for the managers to actually pick up and recoup some of this performance going forward. Are there any other questions?
So I think you've explained where we are really. So question of market conditions, which hopefully are going to be a lot better, and we'll pick up some of the underperformance that we've had in both sets. Has anybody got any other questions that they want to ask? No? Okay. So thank you both for coming along. Roy?
Sorry, Chair, just an afterthought. On the global active grade bonds, I think one of the targets says you can invest 10% in UK and US. Don't say only 10%, it's just a little bit ambiguous.
I think that is the government bond.
Yeah.
You can invest 10% in UK and US government bonds.
But only 10%. When you can invest 10%, you could presumably invest 20%. The actual guideline doesn't specifically limit it to 10%. So just a bit of ambiguity, I thought.
Oh, the IMA for the investment grade actually tells them they can only invest up to 10% in gilts or treasuries. They can't invest anymore because it is an investment grade corporate bond fund, and that is what we wanted to keep it. We wanted to make sure that we don't move it to anything else. But it's just to give them some avenue to actually keep some liquid cash so that they can monitor the rollovers for the FX currencies.
I wasn't questioning the strategy or the guideline, just the wording wasn't clear enough in that it didn't actually say that they were limited to 10%.
That's obviously an error on our part for the slide that we've done, that we've not made that more obvious.
Okay, Anne-Marie, carry on, and we'll take any other questions at the end.
I think, well, we did it, as you can see, we've done a slide on the market outlook. I think we've already touched on this quite a little bit. We do think that interest rates will be kept quite high for the short to medium term. The higher for longer seems to be the expected route forward for the market at the moment. Inflation is beginning to peak now and starting to reduce. So we do think that this will help the fixed income sector and will provide a much better environment for them. And once again, the attractive yields in the fixed income sector now are far better than they were when these funds were launched. As I say, the yields for the investment grade corporate bond has actually doubled now, so it is a much better environment for managers to invest. With the sell-offs that we've had over the last few months, there are a lot of opportunities now to pick up on some of the rebounds that some of these sectors will make as the market corrects itself. So it does look a lot more positive moving forward for this market and this sector. We did have a slide on the responsible investment and engagement, if you wanted me to quickly run through that one. As you can see, the table at the top is showing some figures that our RI&E team have put together for us. As you can see, it's not ideal at the moment. There is room for improvement on the actual reporting for fixed income. The data available for our funds at the moment, this is across all the funds that Leicester are actually invested in, is running at about 52%. There's just not the data available for some of the sectors that we have to give a true reflection. But it does show that the figures for carbon, it has actually broke it down to the different sectors, as in general reduced this year when compared to last year's figures. Now, this isn't, I will caveat that with, this isn't as a result of completely RI&E considerations. The managers and the funds and LGPS Central do think that this is a huge part, and it is a large part of the managers' strategy and how they work things and how they choose investments. But the actual reduction is because they're coming out of utilities at the moment. It's more an asset allocation decision that they've done. Utilities tends to be a sector that managers go into when markets are difficult, because it is quite a conservative strategy and it does help protect. And at times like this, the carbon footprint will be higher because we're moving into a market environment where financials are more attractive at the moment. And this has actually reduced the actual carbon footprint of the fund. We've actually provided an example as well of one of the engagements that one of our managers have done on a Brazilian mining company, Vale, where they actually had a 2-year engagement with the company on their management of thermal coal assets, and actually along with the company they actually worked with them. The company actually sold those assets, and not only just sold them, they made sure that they sold them to a responsible investor who would actually manage these assets effectively going forward. And so they thought that that would be a good example of how our managers are working with companies to actually move forward on this area.
Right, Mr. Gurnley.
Yeah, well, it wasn't a question as such, but it's just good to see that the carbon footprint is going down on the investments of whatever reason. Also, engaging with the various companies, the example that you have put in, which is good. We do need sort of more of that as part of the responsible investments that we do have in place. So it's just want to pick up on that.
Okay, thank you. Have got any other questions? Yeah, Zubir.
Thank you. Just on the outlook, and again, it's maybe my lack of understanding, but these things are quite technical. So I'm just trying to think, the higher for longer rate environment we're in, those are the conditions that brought about the pressure on the fixed income market. That's going to remain for, I think yesterday there was an announcement saying IMF are saying another 5 years, possibly, for which things turn down. And I think earlier there was a question about what do we think the returns could look like going forward, and I think you said it's currently 3.5, but it could be double that. So in a simple way, I'm trying to understand what's going to make that swing and change whilst we got the higher for longer environment. Yeah. Does that make sense?
Yes, the market has already priced in these higher interest rates now. It was the actual it was how quick the interest rates went up, how sharply, that it was the market playing catch up with that impacted the markets, and the fixed income sector are particularly susceptible to these interest rate changes. So it was, I mean, as you know, interest rates went from virtually zero to where they are today in a very short space of time, and it was that was causing the impact with the sector and the underperformance and just the general challenges in the market. So even though it's higher for longer, it's more stable now. So, and the market, the pricing is already there in the market. So the volatility should subside now that we've actually reached that point.
So we should start to see bond prices creeping back up then?
Yes.
Or they already are catching up?
We've already seen in some places, so there are some recoveries in some of the areas, yes.
I suppose from the portfolio perspective, as long as the bondholders are able to pay the coupons on time, that's good for the fund.
Yes, it is.
Okay.
I have nothing else to say, but I am happy to answer any more questions.
So, has anybody got any other questions they want to ask? No, it appears not. So, it clearly a difficult presentation given the market conditions really conspired against the mandate of the funds and everything else. But you know, it's not unreasonable to hope that things will get better over 12 months. So there's every indication it will, but no more than anyone else, you don't have the power of prophecy to see what's going to happen in the world, which is disappointing. Look, thank you both.
You'll be a lot richer.
Yeah, exactly. Thank you very much, Anne-Marie and Cara, for coming along today. Much appreciated. The committee is asked to note the report. Is everybody happy to do that? Yeah, lovely. So we're now on to agenda item number 7. Listed equity transitions update on pages 29 to 40 of the report. Foolish, if you could do a presentation, on that, we appreciate it.
Thank you, Chair. The purpose of this report is to update on the progress with respect to the listed equity changes which were approved on the 19th of April 2023 at the meeting of the Investment Subcommittee. I'll move on to the table under point 2, which describes the 2022 to 2023 SAA changes for listed equity. You'll notice we've gone from a 42% weighting to a 37.5% weighting, a 4.5% reduction. So in line with the agreed SAA, Hyman's reviewed the asset class in April. Listed equity review covered all of the assets managed by Legal & General, which manage all our passive equities, and the 3 equity funds at LGPS Central, where the 3 active funds reside. In total, those investments are about 2.5 billion. Points 4A to F describe the recommendations approved at that meeting of the ISC in April. I'll run through them really quickly, but in part A, enact the reduction from 42 to 37.5. Once the outcome of the central global equity manager procurement is concluded and deemed satisfactory by Hyman Robertson, continue with appointing a transition advisor to aid in the formalising the timeline and strategy of the following changes. That part isn't complete. Is complete rather. The transition advisor has been appointed. Parts C, D, E, and F are the individual elements that need to be amended to take us from 42 to 37.5. I won't read them out unless there's any questions. No. Part 5 looks at the transition advisor update. I mentioned earlier that the transition advisor has been appointed via a framework. The fund appointed Hyman's Robertson, who are ranked the best value for money and able to satisfy the scope which was provided. The advisor has now prepared a strategy and timing of the agreed listed equity changes. It's in 4 parts, in 6A, B, C, and D. The first part in 6A is complete, and that's the reduced exposure to LGPS Central's Climate Multi-Factor Fund, going from about 15.5% of assets to 12%. And that was completed last month, and we utilised an opportunity where another partner fund within Central wanted to buy at the same time, so we avoided some costs there. About £220 million in cash proceeds have been sent to the fund. Part 2, or phase 2 rather, 6B, summarising, is to reorganise the legal and general holdings into what you see in 4C, which is to reorganise into a legal and general equity fund, an all-world equity fund, and a low carbon transition fund. So effectively 3 funds. Phases 3 and 4 reorganise the holdings at LGPS Central, and they talk primarily about the 2 funds we hold with them, which is the Central Emerging Market Equity Fund and the Global Equity Fund. We think all transitions will be completed by the end of the current financial year. Dialogue between officers, transition advisors, investment consultants, LGIM and Central on timing, managing the market exposure and pending any late market events will continue as necessary, may mean that the transition could be delayed further into 23-24. As a result of the strategy agreed between the transition advisor, the levels of cash being held by the fund will be higher than in previous years, whilst awaiting to be called by the managers where the fund has made investment commitments. There is a risk that whilst holding cash, the return may be lower than could have been if we were still invested in the equity allocation. We've taken that into account, given that we are moving towards a 37.5% allocation in equities between the transition advisor and our consultant. We think that's the most preferable course of action to take. Any questions?
So, has anybody got any questions they would like to ask? Yeah, Roy.
It's a quick one. What do we do with the cash when you've got big cash holdings? Does it go in the overnight market, or how do you get benefit from it?
Yeah, good question. We've not held this amount of cash for a long time, at least not in my time at the fund, and we've got another paper next to talk about a cash management strategy. But you're right, we invest it in a variety of different places to earn anywhere between 5 or 6%. But we'll come on to that into the next paper as well.
Okay, so any other questions? No, we're not going to have a question. So the committee is asked to note the report. I'll take it as being noted. Is everybody agreeable to that? Yep, thank you. So the next item is agenda item 8, and is the cash forecast to year end 23-24, and also our cash management strategy, which is shown on pages 41 to 50 of the agenda. Bulesh, once again, if I can ask you to present the report, please.
Thank you, Chair. So yeah, it's talking about the cash forecast to the year end, which is a standing item each quarter, but we've also added a cash management strategy for the reasons we talked about just a moment ago, holding way more cash than we have previously. We'll run through the quick bit of background in the sense that the last update, June, the cash balances were just 54 million, with another 50 million at the fund's currency hedging manager, Aegon. We don't have a specific cash allocation as part of the ASCA, other than a limit of 0.75%, which represents the cash held with Aegon for the currency hedge. So we do try and keep cash at a minimum. The fund has previously attempted to keep cash balances as low as possible. Again, a 0% holding is most preferable. And as a result of the equity holdings that we've sold recently, the fund is likely to hold high levels of cash into the coming year, and therefore a cash management strategy is to be considered as part of this paper. Moving over to the table on page 42, you can see a comparison of the 2022 and the 2023 strategic asset allocation. If you're looking at the table, the headings are back to front. So the first numbered column should be 2022 and the second one should be 2023. I'll just highlight the major changes just so we can recap in our minds. The listed equities go down by 4.5%. Targeted return goes down by 2.5%. That money largely ends up in the income assets within infrastructure and within global liquid investment grade market. So a product like MAC, for example. Moving on to the table on point 13 shows the effects of the commitments that we've made in order to close those changes to zero. So you can see on the table on page 43.13, that the last column there shows where we would be versus the 2023 allocation had all the commitments we've made to date been called. There's only two to kind of point out there, in the sense that there's a it looks like there's a 5.9% over allocation to MAC, to global credit private debt. In all honesty, that takes into account all the commitments we made. They won't be called in the next year. What will happen is money will come back from old vintages and new money will go out. So hopefully that'll smooth out over time. And it looks like we've got a 0.8% under allocation to property, which we're looking to allocate to further in the coming 3 or 4 months. To reiterate, the direction of travel over the last couple of years has been largely the same. It's been to reduce allocation to the growth asset group and to allocate to the income asset group. The most recent SAA upheld that view also. Looking to move to point 27. On page 45, it's just talking about the higher levels of cash. We've talked about numerous times over today. The target to listed equity is 37.5%. We will be holding slightly more than that over the next six months to a year as we reorganise the listed equity, and that will throw off cash. We're going from 42% to 37.5%. What we've done there is to try and understand when we're going to need it. We're going to try and minimise the amount of cash we can hold. We think we'll be ending up at around 190 million by about March 24. And the rest of the paper talks about what we intend to do with the cash whilst we're holding more cash than we expected. So we've got, from point 32 onwards, a cash management strategy, and we don't have one currently. It does, however, currently use money market funds, and those are just highly liquid and secure funds where money's parked overnight in AAA rated funds and securities. What we've done is we've utilised the county council's treasury policy, and we've further kind of constrained that to produce a table which you'll see at page 37. Now, the table at page 37 shows 7 types of investments that the pension fund can hold. In reality, we'll probably use 3 or 4 of those. The rest of them on there, things like the last 3 on the table, which are term deposits with the Debt Management Office, the UK government treasury bills, and term deposits with other UK local authorities, are not likely to be held, but they are ultra secure, and we may need them if we do need to hold really ultra secure holdings. So we'll tend to hold money market funds and term deposits with banks. We'll try and minimise the amount we hold with each money market fund so that we've got a smaller amount with each. So you'll notice in the table that we'll try and hold. We've got accounts with 5 money market funds, and we'll try and hold a max of 50 in each. I'll just mention at point 41, cash held with Aegon is currently held with banks. We're going to have to try and amend their investment management agreement so that we hold the cash with them in a similar manner to the policy that's being approved here. So a little change to their investment management agreement will be required. And the last point on there, 42, for completeness, the management of excess cash is not a investment subcommittee decision, and as such, pension fund cash will be managed by officers in line with this policy. Any questions?
Yeah. If you invest with banks, would we be subject to bail-in then if the banks got into trouble? Have we taken that into account?
So, suspect there's all sorts of considerations here. If there is a bail-in as such, we'll try and minimise the amount we hold with any single bank. I think our Treasury advisor Link would have early foresight of that, and we'll apply the same learnings that we get at county to the pension fund.
Do you have a limit for each bank?
I suppose just for everybody's benefit, things like FCA compensation, things like that, we're just not in the sort of the ballpark of that, as we sort of put millions into it rather than sort of tens of thousands. So it's not sort of a risk-free kind of endeavour. As Boulas just touched on, Link do sort of trim it right down, looking at both sort of credit rating, things like credit default swaps, which is basically a bit more of a live indicator of the risk of sort of the banks going into default. But we'll spread it out as much as we can, and we do top and tail Link's risk list as well to reduce the most risky banks. But to the final point Nick made there, we do, and it should be in the appendix, is it, of the limits we were proposing to put with each bank. So it's still quite meaty, it's in the tens of millions, but the problem is the further you spread it across more banks, you end up having to get into the more risky banks as well. So you're damned if you do, damned if you don't kind of scenario. But it's best of a bad job, I suppose, best of a bad lot, I suppose.
So I might add, Chair, the bailout for £85,000 is only for personal accounts. It doesn't touch any corporate businesses.
Yeah, I mean, I think Link Asset Management monitor on a daily basis, and if there is any credit changes in the credit worthiness, they would advise us, as they would for our county council policy. So,
maybe just give a bit more assurance. Through the financial crisis, Icelandic banks, going back BCCI, we didn't get caught with any of those because, like I said, the Link list is pretty prudent. We make it a little bit more prudent again. So it's not 100% guaranteed, but it's pretty good. So.
Well, thank you, Declan. I think within, I don't want to tempt Providence, but within reason, I think we have managed it quite well if we've avoided Icelandic banks, BCC, various other things. So just continue on that vein, please, and we'll be fine.
Yeah, Credit Suisse wasn't on the list. Yeah.
Anyhow, we won't talk about it anymore because it's don't tempt Providence. Yeah. Bullish, have you got some more you'd like to say?
No. Other than we'll try and reallocate the cash as quickly as we can, but decisions and markets can move against us, and although we think we'll be at about 190 million by the end of the year, it could be wildly different.
Yeah,
keep updating through the
no, I think we accept what you're saying. It's we can't just blindly follow if the markets change and we're not able to do the investments. Has anyone else got any other questions they want to ask? No. You put your mic on.
Yeah, just a comment really is that, as mentioned before, really to Bullish, is that the amount of cash that we held was probably really did need to be minimised a couple of years ago. It's less of a problem now, I think, at 5.5% that you're getting. It's not that much of a hit on the fund, I suspect. Get it right down to nil isn't quite as critical.
I think fair comment. Yeah, I think things have changed and interest rates are going up. So, if we have no further questions, comments, no, we haven't. The committee has been asked to approve the cash management strategy set out in the table at paragraph 38 of the report. I'm happy to move the recommendation. Do I have a second? Thank you, Mr. Grimley. All those in favour? That's unanimous. Thank you. So the final substantive item on today's agenda is agenda item 9, recommended investment to private equity products at pages 51 to 70 of the agenda. We've got Philip Pearson from Hyman's has joined us for site, and he will deliver a short presentation to us shortly. Bullish, do you have anything before Philip launches into his?
I'll introduce this paper, Chair, and then Philip carry on. Okay. Purpose is to seek approval in respect of private equity commitments covering 2023-24 and 24-25. So 2 years, similar to previous recommendations brought to committee. The latest SAO was approved in January 2023. There was a high-level target for private equity set at 7.5% of total fund assets. As at the 30th of June, the actual weighting is close to 7.5 at 7.4. Points 4 to 5 contain info regarding previous investments into private equity. So the fund invested last into an Adams Street Partners Global Fund at the back end of 2022 for $26 million. One further investment was made in 2022 to the Adams Street Partners Global Secondary Fund 7 for $38 million. Point 5 talks about the 2 central investments that we've made. They've launched 2 vintages since their inception, one in 2018 and one in 2021. The total amount committed to those 2 vintages is £40 million. Just moving on to point 8 very quickly. Commitment to PE is being recommended as a result of assessing and maintaining steady allocation to this asset class. I think Philip's going to talk through the kind of cash flow forecast we've gone through here to kind of understand the percentages that should be returned to the fund, and therefore how much new money needs to be added to private equity to maintain that 7.5% weighting. We're also going to look through the target allocation to various origination channels. So that's things like primary funds, co-investments and secondary funds. Now, this kind of framework follows what we've done with previous asset class reviews for property, infrastructure and private credit. So it's becoming quite a normal strategy for us to be able to maintain and monitor in-house the kind of allocation to that framework that's been agreed at subcommittee. Philip will go through those in more detail also. Other than the recommendation, which we can come back to, I think it's probably a good time to hand over to Philip.
So over to you, please, Philip.
Thank you, Chair, and a very good afternoon to everybody. Just briefly to introduce a new face, new colleague of mine, Russell Oates, who's joined the Leicestershire client team, really to give us some more capacity and ability to respond to your challenges. I'm here to talk about the private equity commitments, and I thought, Angie, if I could just, okay, when you get there, if you could get slide 2 up, just to provide a bit of context for the commitments that we're recommending here. Firstly, just a reminder why we invest in private equity, and that is to generate a positive real return over the long term. With included in that return a reasonable liquidity premium relative to listed markets, because these are illiquid investments and that brings risk and you should be rewarded for that risk. And then also expecting capital gain to account for a very high proportion of the total return generated, because these are or should be high growth companies. As Bullish mentioned, the fund is more or less at target allocation, but you do need to make regular commitments. And the reason for that is that you invest through closed-ended funds. When those funds sell assets, the capital is returned to you, so you have to reinvest it. Looking at the cash flows over the next 5 years, the capital that will be drawn down by your existing managers and the capital that they will return to you. We reckon that you need to make new commitments of about £80 million per annum over that period in order to maintain the exposure at the target allocation. Private equity is just about the highest risk asset class that you're going to invest in. So we think it's really important that the portfolio is well diversified by life stage. So venture capital, yes, that's new and early stage companies. Growth capital, the companies looking for capital to bolt on acquisitions or to expand their businesses, and also buyouts, which is used to be the bread and butter of the industry. Diversification by geography, diversification by economic sector, by vintage year, which is why we try and recommend regular commitments every year. And just as important as anything else, diversification by manager, which is why we recommend a multi-manager approach. We also think it's important to leverage the different ways in which you can invest, which I sort of called here origination channels. So most of your investments are made and will be made by primary funds. So these are pool funds that invest in underlying companies that are managed by third-party private equity specialist managers. There are also opportunities called secondaries, which is to buy interests in primary funds in the secondary market, at times at a very significant discount to the net asset value of those underlying funds. And now happens to be one of those times when you can achieve really significant discounts. And then finally, the other route is co-investments. So this is where the fund would be invested directly in the underlying portfolio companies. So it concentrates risk, but the reason for looking at is it tends to be a much cheaper way of getting exposure to the underlying companies. So we think try and exploit the different origination channels. Angie, if I could turn over to the next slide. We've proposed the following target allocations by geography at the top, by life stage in the middle, by origination channel, the next block down, and you can see there that the bulk of the exposure will still be via primary funds. And then, we think it's really important to have diversification by economic sector, but we don't think that you should set any rigid targets for any particular sectors, because the sectors that are of interest change over time. You'll see we've proposed ranges, and the purpose of those ranges is to provide flexibility around the current market mix, flexibility for the fund, but also for the underlying managers. And the idea of these target allocations would be when we're considering new investments going forward, we can see how those new investments would slot into the overall portfolio and achieve an appropriate level of diversification and balance of risk. So I mentioned that we need to make some new commitments, and there are sort of two obvious options for doing so. One is the funds offered by LGPS Central. There are two series of funds, a primary fund programme and a co-investment fund programme. You previously invested in two vintages of the primary fund programme, which provides global exposure, pretty well diversified, although no exposure to venture capital. Focuses on primary funds, doesn't give you any exposure to secondary opportunities. It's multi-manager. The early track record of the investments that you've already made are pretty promising. And finally, we've done a refresh of the due diligence that we carried out on this programme a couple of years ago, and that has thrown up no major concerns. So we're pretty happy with putting more capital into that particular vehicle, the new series of that vehicle. We also re-looked at Central's co-investment proposition. It does what it says on the tin, invests in co-investments globally. These are co-investments that are originated and evaluated by the LGPS Central team. So they would be investing directly in underlying portfolio companies on your behalf. The early track record of the existing vintages of this programme has been pretty strong. So we were tempted to recommend an allocation, but we still have concern that the team doesn't have the capacity to originate and evaluate enough deals and to be selective enough, which is what you absolutely must be in any private markets programme, and particularly private equity. So on balance, we're not recommending any commitments yet to the co-investment programme. Looking specifically back at the primary fund programme and thinking about what it can and can't invest in, thinking about the bias towards using the pool wherever you can is obviously entirely appropriate. Taking all those things into account, we would recommend that 50% of the commitments are made through the LGPS Central Primary Fund programme. That leaves the question, what to do about the rest? And the obvious first answer to that question is to look at your other main manager, Adam Street. They do a whole variety of things. Their flagship is the Global Fund Programme, which I've profiled on the left-hand side of this slide. This does pretty well everything. It invests globally, very well diversified by geography, life stage, origination channel. It's multi-manager, run by a well-resourced team, strong track record. It will charge you, Adam Street will charge you more fees, circa 50 basis points, depending on how you measure it, which is significant. But I would highlight that that difference is likely to be partly offset by Adam Street being able to negotiate better terms with the underlying fund managers, who I'm afraid will also be charging you fees, than Central are able to do. And that's not to, to be critical of Central as a team. It's simply that they are not putting as much capital to work in the market as Adam Street are. And when it comes to negotiating management fees, capital, size of commitments matters. We haven't repeated our due diligence on Adam Street, but we do rate the manager preferred, and that means we're continually monitoring them. So we are very comfortable with that particular program. The alternative would be to use one or more of their specialist funds, and you've previously invested in venture funds and co-investment programs and in secondaries. And using those specialist funds would allow you to more precisely tailor the exposure to your target allocations. Would also leverage Adam Street capabilities in those areas as well. But the fees are higher than the Global Fund Programme. The vehicles are only launched sporadically, not every year, which will give you less flexibility in terms of the timing of your commitments. And the fund would be responsible for picking the mix of venture versus buyout, of co-investment versus primary, of secondary, so on and so forth, which we suspect you probably don't want to do. So on balance, our recommendation here would be to put the other half of the commitment in the Adam Street Global Fund Programme, and specifically into the 2024 series, which is just about to open. The first close would actually be December 2023. So your commitments would start the process of being invested relatively soon. So to summarise then, recommended commitments for 2023, a half or 40 million in the LGPS Central Primary Fund Programme, the other half, which comes to around $49 million, in the Adam Street Global Fund Programme, totalling £80 million. And then in 2024, indicative commitments of another 80 million, with the level and the split of those commitments to be finalised this time next year, I guess.
Okay, thanks for a clear presentation. Has anybody got any questions? Nick?
Thank you, Chair. Comments really within that. First of all, I think private equity's done reasonably pretty well for us over the years, and the liquidity premium means that we're not desperate for some of the cash for another 10 years. So that has a price. I'm interested to know what price that actually can be calculated at. The other thing is interest rates are much higher now. Does that make private equity more of a risk and less attractive? And finally, the question of fees within that. You've got Adam Street, which charge you a chunk. You say 50 basis points, and LGPS Central charge you not a lot. But it's the underlying fees behind that from the managers that's probably the big one. How much are those, and are there any performance fees within that? Yep.
Sure. Lots of questions. I'll try and deal with them in order, but please nudge me if I forget any of them. So private equity has done you really, really well over the last few years. Valuations have sold off a little bit in the last year or so, but nonetheless, you have done very, very well out of private equity. I think it unlikely that you will do quite as well in the coming 5 to 10 years, I'm afraid. But that's not a problem, providing that private equity pays you a decent premium to the return that you could earn with less risk in listed markets, which was your second question. We look at the stats on that, and that suggests that on average, private equity has outperformed listed markets by about 4%. You've done a lot better than that, but that's sort of on average over the whole market. When we do our strategic asset allocations, we assume that private equity will only outperform by about 1.5% years. So pretty prudent when we're sizing the allocation. But I think the main message here is yes, you should expect over the long term a reasonable premium to listed markets that compensates you for the added risk that you're taking. On looking at the outlook and in particular on interest rates, most private equity investments will be leveraged. So as interest rates go up, the cost of that leverage will go up, and all other things equal, the returns will come down slightly. That doesn't worry us, providing that the managers avoid the very, very highly leveraged, typically very, very large buyout funds, which good private equity managers do tend to avoid. They tend to focus on less highly levered mid-market buyout opportunities, and also you have a reasonable allocation to venture, which may not be leveraged at all. So I think higher financing costs will temper returns, which is why I say you probably won't see the returns that you have done over the last 5 to 10 years. On the thorny issue of fees, Central will charge you 5 basis points. Adam Street will charge you, on average across your existing holdings, charge you 55 basis points. Their latest vehicle, and this would be the fee that they would charge going into the 2024 programme, they would charge you 38 basis points. It's materially more than the Central fee. Neither of LGPS Central nor Adam Street charge you any performance fee on the Global Fund programme. There are, though, I'm afraid, fees from the underlying managers, and transparency on underlying management fees is borderline dreadful, if I'm honest. It's really difficult to get that information out of Adam Street. Pretty difficult trying to get it out of Central, probably reflecting the challenges that they have getting the information from underlying managers. Those underlying fees are substantial. The standard fees in private equity are 2% management fee and 20% performance fee. So really, really significant fees. Good multi-managers like Adam Street or Central will negotiate you decent discounts on the management fee, 10, 20%. They don't have much luck negotiating discounts on the performance fee. So you'll probably be paying 20% of any outperformance to the underlying managers. But it is important that the manager tries hard to, and the multi-manager tries hard to negotiate those underlying manager fees, and uses all its skill and capital clout to get the best possible discounts. And that is why I think Adam Street will have more success negotiating discounts than Central will. Hopefully that covered all your points.
Yeah, thank you very much for the comprehensive answer. It's the underlying management fee that worries me rather than the individual ones between Adam Street and Central, and particularly the 2 and 20 sort of scenario. Very concerned that they're actually opaque in actually telling us what those fees are. That's a matter of worry for me, because if it's 2 and 20 over time, the managers take the money and not the investors. In terms of the performance of the 20, is that clawed back? Is that over time, so that they overperform, so they claim it, and then underperform, and then there's nothing before? That seems to be a pretty fundamental argument about the fee structure that we need to make sure about.
Absolutely, and the way those performance fees are structured is, first of all, they only get paid on outperformance. So the underlying funds have to return above a particular target return, which will vary between the different underlying fund managers before they get any fee at all. Often, they only earn the fee when the underlying investments that have generated the outperformance have been realised, and you've got the cash back in your hands. That's generally how it's structured. Where those fees are, those performance fees are calculated on unrealised gains, which are obviously susceptible to mark-to-market volatility and all the rest. There will usually be some clawback mechanism in the event that performance suffers after the performance fee has been paid out. But in general, in private equity, the performance fees are calculated on realised gains.
Okay, thanks. That's very interesting. I think, although not totally reassuring, it's reassuring to hear that the 20% is actually only on the outperformance of the against the target rather than the whole lot. It's the opaqueness that you're worried about. Yeah. 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 Yeah, and there is some element of clawback if they don't perform or something goes wrong. So that's reassuring. So has anybody got any other questions? Oh, Roy.
Going back to the geographical targets you got, I thought I saw somewhere in the figures that you were quite considerably overloaded into the US market. Is that not the case? I saw some statistics in one of your figures.
Yes, the fund currently is. That largely reflects, because the fund is invested largely in global fund programs currently. It largely reflects where the managers in question, and particularly Adam Street, felt the opportunity lay at the time that the commitments were made. And we shouldn't therefore be too surprised about a significant exposure to the US, because the US economy has powered on in recent years, and in particular, sectors that private equity has focused on in recent years, being information technology and life sciences and business services. Information technology and life sciences, the US has really led the charge in terms of new ventures and private equity. So that is why we are where we are. I would, looking forward, I confess, be more comfortable getting that geographic exposure back within those ranges, which after all are reasonably broad. but I think it's important that the underlying managers have the flexibility to go where they see the opportunity at the time, and we, and I would count in that both the fund and also Hyman's, don't do too much to second guess them on the markets and over constrain them on where they can invest.
I'm nervous about the States given the geopolitical situation, though there's no speaker of the what do we call that, equivalent to the Commons, Congress, and the two candidates for the president are not the most exciting prospect. So I think we should try and get back to within what's a prudent level.
I'd probably just add there that we're probably expecting the best part of what, 160, 180 million and coming back from Adam Street over the next 2 years. So where we do decide to reallocate that will represent those target allocations you saw on the previous page. So we will nudge back towards target ranges over time.
Second question on a similar basis. There was talk of a percentage for Europe. Does that include the UK, or is it UK accepted?
That would include the UK.
Yeah.
Yes. And just to follow up on a point that Bullish made, in terms of new commitments to Adam Street and to Central, the geographic ranges that both of those managers operate are consistent with the target allocation ranges that we're talking about here. So over time, providing they stick to those ranges, we should naturally come back within our targets.
If I may, what's your view on the Pacific Rim? Do you not think that's a very strong growing area we should perhaps be more into?
It is, and private equity managers are increasingly targeting certainly developed economies around the Pacific, but certainly obviously the western end of the Pacific. The reason for proposing a smaller allocation to Asia is simply the fact that the private equity markets are smaller than they are in North America and Europe. So what we don't really want to do is to signal to managers, look, we're happy for you to take twice the number of opportunities in relative to the market in Asia than we want to see you taking in North America. I think that would be the wrong signal in terms of making sure that they're selecting the best possible deals for the fund. But Asia is growing, and managers are increasingly targeting it, and we'll see their allocations to Asia growing over time. And they're also starting to target emerging markets as well. Now we've allowed for a small allocation to emerging markets, and that's really to facilitate managers in their investment programs without taking on too much risk for the fund.
Would you consider India part of the emerging markets? It's the biggest population in the world now.
India would be very definitely part of an emerging market allocation, as I'm afraid would China, for the same reason. Indonesia, Turkey, those would be Brazil. Those would be the now fairly large, in some cases very large, economies that are starting to get their capital markets together, which is creating opportunities for, frankly, Western, usually private equity managers to invest. So those were the sort of places they tap at.
Thanks very much, Roy. I think you frightened us all to death, really, with your scenario. We'd never invest anywhere. Subir.
Just looking at the mandate specifications, there's a table in one of the papers we've got. Just looking at the primary investment characteristics, I don't know if you've got that to be able to look at. I note primary investment characteristics seem to be softened, if you want to call it, as we've gone from PE 2018 to 2023. Is that just I'm just trying to understand, is that because those are becoming more mature, etc.? I'm not sure what's driving that. Does that make sense? Sorry.
It does, and it was a specific point that we challenged Central on, because I couldn't make sense of it when I first looked at it either. Their reason for softening both the number of prior funds they wanted the manager to have run, and also the size of the minimum size of the prior fund, was that they wanted to be able to allocate to experienced managers who were launching for the first time specialist strategies focusing on a particular area of the private equity market. So it could be a fund focusing on life sciences, or quite a common example. Or the other example they gave me was a fund focusing on logistics technology. Also see why that would be an interesting area. And these would be experienced managers who had actually invested in those opportunities before within a main fund, but had decided that the opportunity set's so good that they want to carve out a specialist fund focusing on them. So Central's argument was, look, that particular manager would absolutely have the experience of investing in that area, but they might not be able to show the track record of a specialist fund because that's the first one they've launched. And on that basis, we were relatively comfortable to let Central place capital with those sorts of managers. The other thing we said was, well, okay, but if these are specialist funds, then you wouldn't necessarily want huge allocations to them, would you? And the answer was no, they would restrict the size of any commitment to that sort of strategy.
And that's really helpful. And I suppose in a way it lends itself to, when you look at the segmentation, if you want to call it, the growth section under life stages is only at 4% currently. And maybe that's the space they're looking for these people to come in and exploit potentially. So you've got to give somebody that opportunity to exploit that. Okay.
Absolutely right. Yeah.
Okay.
Yeah.
Okay, well, we've had a fairly lively debate and been around the world political situation. Has anybody got any other questions they would like to ask this afternoon? No, it doesn't look as though they have. So committees recommended that we use the general fund balances, which will be called over a number of years, to fund the investments as set out on paragraph 27 of the report on pages 55 and 56. I'm happy to move the recommendation. Do I have a second? Thank you. Is everybody in favour? Yep, that's unanimous. Thank you very much. So the next, that concludes today's meeting. The date of the next meeting is the 13th of December. Thanks very much, Philip, for displaying your knowledge, which is clearly greater than ours. But I think it's given us a very clear understanding. I genuinely think it has helped a lot. So thank you. Roy.
Can I just ask a quick general question?
You can.
Do we as an organisation have a picture of how much of our money is in which parts of the world between all of the various funds, or would that be a nightmare scenario trying to work it out?
Ulesh, it's a good question for you.
We don't hold a quarterly record of where it is, but we do have manager reports that do tell us the geographical allocation. So with a bit of spreadsheet work, it's not beyond difficult.
It was it wasn't long ago that we, with the Russian investments, that we did very quickly got figured to find out how much we did have invested in Russian time, which was very little, which was quite a relief.
Yeah.
I think the information can be got fairly quickly, can't it?
If we need it, yeah. Look, so thanks everybody for your contribution this afternoon. The date of the next meeting is the 13th of December 2023 at 10 o'clock. If there's any changes to that, we will let you know. And that concludes this afternoon's meeting. So thank you very much, everybody.